Hey guys, how are you? Hope you are doing good. So today we are going to discuss about derivative. I know you have heard this term quite a lot and you are quite confused what is derivative and you have heard, right? There's a call, there's put, there are futures, there are swap, right? We never understand. So let's try to understand it a bit. What is derivative, right? And people say derivative is an instrument which derives its value from some other instrument. But do we really understand that? So to understand that, let's go to the before, how the derivative instrument came into picture. So this story is somewhere around 1901. In Japan, what happened? There are farmers who are producing wheat, right? And they're really scared that we are going to produce wheat, and what if the price after we produce wheat, the prices of those wheat will come down. So they're little hesitant or reluctant to produce wheat at this point of time. And there are like certain people who are producing bread, right? And those bread producer wanted wheat as a raw material for producing that bread, right? And they are really scared that what if the wheat ka price has gone up, right? So if you see, they are the perfect match for each other. There's a wheat producer who is scared that what if the wheat ka price will go down, and there are bread producer who are scared that what if wheat ka price has gone up. So what happened? So that wheat producer was sitting near a banyan tree, and he was thinking about that. Then that bread producer came and he said, "Okay, let's do one thing. Let's enter into a deal that after 6 months, whatever wheat you are going to produce, I'll buy at a current price. And no matter, irrespective of whether the prices are gone up or gone down, you're secured your hedge." And he said, "Perfect, you have made my day. So now I can prepare or I can produce wheat with my mind free that I'm going to get this price." Right? And this contract, nowadays we call it as a future contract or a forward contract, right? So that is a typical contract and which is going to happen in future at a predefined rate. So this is one of the derivative contract, right? And gradually, I think we have gone a long way. So it's been almost 120 years, 120 plus years, right? And we have derived a lot of derivative instrument, right? So the typical derivative instruments are futures, forward, options, and swap, right? So future we understand, right, which is going to happen in future, right, or forwards. So there are two terms, future and forwards, that are used interchangeably. So forward contracts are over the counter and futures are something which happens over the exchange. So what's the difference between the two? If I have listed this contract over an stock exchange, that is called future contract. But if it happens between two parties, it is called bilateral forward contract, right? So which is not listed in the market and that can happen between two parties, right? So a future contracts are standardized contract where everything is fixed and that will take place in exchanges. But a forward contract happen between two party and we can do a lot of customization there. So that's a basic difference between futures and forward contract. Now let's come to the option contract, right? So in option, we have two typical option, right? We see call option and put option. But before going to option, you know what is option, right? Option means I have an option. So in an option, there could be a buyer of an option, there could be a seller of an option, right? Either I can buy an option or I can sell an option. You know, right? Whenever you go to take a insurance, right? A term insurance or health insurance, what it says that if something bad happens with you, I'm going to make you a whole, right? And all you have to do is give me a premium. So that insurance company is actually giving you an option. So you are buying an option at a premium and that insurance company is selling you a premium, right? And same thing happens in case of an option in derivative market. Either you can buy a call option or you can buy a put option. What you have to do, if you are buying it, you have to pay a premium, and if something happens in a future date, they're going to make you whole or they're going to pay you, right? So in call and put, there's an option buyer and there's an option seller. Option seller is also known as option writer. Okay, so far I guess you are with me. So if you are buying an option, you have to pay a premium. If you're selling an option or writing an option, you will receive a premium. Okay, so far with me. So you have to understand either you are an option buyer or option seller. If you're buying an option, Upfront, you have to pay a premium. If you are selling an option, you will get a premium. Okay, let's try to understand what is call option, what is put option. So as the name says, it's very simple. If I have a call option, that means I have an option to call. If I am a put option, that means I have an option to put. So what exactly it is? Call option, if I have to typically define, it's an option to buy on a future date at a predefined price. Supposingly there is a share, right? Or supposing I take Nifty. So right now Nifty is trading around 21,700 level, and I feel like it is going to go to all the way to 25,000. So I'm very bullish on Nifty, and I don't want to miss that bus. But right now I don't have a money to invest at that contract. So what I can do, I can, and there's one more person who thinks that 21,700 is too high. So Nifty is trading at a very high price, and in future they are going to go down. So he's actually bearish from the market point of view, and I am bullish. So what I'll do, we'll say that we'll enter into a contract. I say, why don't we bet? If tomorrow Nifty ka price has gone over and above 700, you will pay me the difference. Okay? And if it goes down, I'll not pay you anything. I said, am I mad kya? If it goes up, I have to pay you. But if it goes down, you will not pay me. I said, yes. I said, why should I enter into that contract? I said, take 100 rupees now, and this 100 rupees, you can keep it. You feel now the prices are going to go down. If it goes down, you can pocket that 100 rupees, right? But if it goes up, then you have to pay me. That is what happened in typical call option. That if the prices goes up, I will feel very happy. But is it like supposedly tomorrow the prices from 21,700 it goes to 21,750? Will I be really happy? Because that person is going to pay me 50 rupees, but upfront I have paid 100 rupees to him, right? So net I am at a loss, right? So there's no point having that contract, right? But in case of a but the seller will be happy because he has got 100 rupees in the upfront and he has to pay back 50 rupees. So net he is 50 rupees ka profit. So there is a concept called break even price, that if I have entered into a contract of 21,700 and I have paid 100 rupees ka premium, once the prices goes up above 21,800, then I'll start making money. Anything less than that, I'll be at a loss. I guess you are with me. What is call option? What is upfront premium? What happened in the put option? Take a second scenario that I am somebody who's very bearish. That I feel like right now Nifty is at 21,700 and it will go all the way to 20,000, right? Can I really do a shorting of the Nifty? Answer is no. So what I can do, I can say that, and there is one person who feel like either Nifty will remain at 21,700 or it will go up only. For sure, it is not going to go down, right? So I went to him. I said, now take 100 rupees. And if tomorrow Nifty ka price goes down to 20,000 rupees, you have to pay me the differential. But what if the prices goes up? I said, okay, you have 100 rupees, you can keep it, but I'm not going to pay anything. So I have an option to sell Nifty at 21,700 in the future date. So in future, if Nifty become 20,000 rupees, right? So that person is going to pay me 1,700 rupees. So that will become my profit. No, that is not become my profit. That will be the payoff that he pays. But I have paid 100 rupees upfront, right? In that case, my profit will be 1,600 rupees. So that's how put option says. So uh, either you can be called buyer, you could be called seller, you could be put buyer, or you could be put seller. Generally, we buy call option if we are very bullish. That we feel like Nifty can really go to 25,000 level. If we feel like it is going to go up, but not that much, rather than buying call, I'll probably prefer selling put option. I know this become little confusing, but we'll discuss that, right? But if I'm not hugely bullish, it's better to take that 100 rupees ka premium now rather than paying so much premium and buying a call option. Similarly, if I am a bearish and not very bearish, then it's better to sell a call rather than buying a put option. I hope you are okay. We'll discuss how the premiums are calculated, how this works in a subsequent videos, right? But for the time being, I feel like you're okay. If you are buying an option, you have to pay premium. If you're selling an option, you'll receive a premium, no matter whether it's a call or put. Call option is an option to buy when the prices are going up. Put option is an option to sell when the prices goes down. I hope you are okay so far. So that is what call and put option is. Now let's discuss about swap contract. What is swap contract, right? Swap is definitely something which we exchange. For example, in our childhood days, we know, right? When we go to our school and we carry our tiffin boxes, right? So our mother used to give us some parathas and all, right? Which we do, generally don't like it. And there's another kid who generally brings sandwiches, which we really like. So what we used to do, we said we swap our tiffins. So I give my paratha to that guy, and that guy is giving me his sandwich. So this makes both of us happy, right? Because I like sandwich, this like guy like paratha. So why don't we swap our position? So same thing happen in derivative market also. For example, I am a person who is in India and I wanted a US dollar, right? I want a loan in US dollar, and there's another person in US who wanted an Indian rupees ka loan. But what happen if I go to US and I take a loan from their bank? They will charge me higher interest rate. Similarly, there's a person who sits in US, he want Indian rupees. If he goes to Indian banks and take a loan, these guys will be charged at a higher rate. So we both come to an agreement that I'll borrow from Indian market, although I don't need Indian rupees, and that person is going to borrow an US market, and we are going to swap our money. This is called currency swap. So I'll pass it on Indian rupees to that guy, and that guy is going to pass it on the US dollar to me. So that we have to pay a lesser interest and we get both benefited out of it. That is a typical swap contract. I hope you get an overall idea what is future, what is forward, what is option and swap. There are like a lot of details which we are going to cover in a subsequent lectures, but I hope that that really helps. So please do put your comments whether you like it or not and what all you want me to cover in our subsequent classes. We'll meet you next time. Bye.